Most people don't realize their investing mistake until it's too late. Because here's the thing, investing $100,000 sounds like a power move, but if you pick the wrong fund, you could be walking away with $2.8 million less than you should have. SCHG and QQQM are two of the most popular ETFs for long-term growth. People choose them every day thinking they're basically the same, but they're not. And in this video, I'm going to show you and John exactly what the difference is. I'll break down how these two ETFs compare, how their performance stacks up, and just how massive the gap can be when you pick the right one, and how much it could cost you if you don't. The difference between the two? $2.8 million. Let's start with the basics here. What exactly are QQQM and SCHG, and why are they such popular picks for investors? Well, think of them as two different playlists. Each one includes a collection of top-performing U.S. companies, but the vibe is completely different. QQQM tracks the NASDAQ 100, which means it holds 100 of the largest non-financial companies listed on the NASDAQ exchange. That includes tech giants like Apple, Microsoft, and NVIDIA. It's basically a slightly cheaper, more long-term focused version of the well-known QQQ ETF. If you're bullish on tech and innovation, QQQM puts you in the front seat. On the other hand, SCHG tracks the Dow Jones U.S. Large Cap Growth Index. It casts a wider net, giving you exposure to a broader mix of growth-oriented U.S. companies, not just tech. You still see big names like Apple and Amazon, but you also see companies in the healthcare, financial, and other sectors. Why are these ETFs so loved? Because they simplify smart investing. Instead of trying to pick individual winners, you own a diversified slice of some of the most influential and fastest-growing companies in the U.S., all while paying low fees and letting time do the heavy lifting. Investors are drawn to QQQM for its targeted focus and history of riding tech waves. They love SCHG for its broader reach and consistent long-term performance. One's more focused, one's more diversified, but both are built to grow. Now let's break down what each of these ETFs actually holds, because that tells you a lot about how they'll behave in the real world. Starting with QQQM, this fund is laser-focused on the NASDAQ 100, which means it is stacked with big-name tech. Technology makes up a massive 49.91% of the portfolio, with companies like Apple, Microsoft, and NVIDIA leading the charge. There are also heavy hitters like Amazon, Meta, Tesla, Netflix, and Alphabet in the mix. Together, the top 10 companies account for just over 48% of the entire fund. That's nearly half the weight riding on just a handful of names. This kind of concentration gives QQQM the potential to skyrocket when tech is booming, but it also means your portfolio could feel extra bumpy when those big players take a hit. SCHG, by contrast, spreads things out a bit more. It holds 229 companies, more than double QQQM's count, and while it still leans into growth, it brings in more sector diversity. Technology is still the biggest piece at 46.7%, but you also get meaningful exposure to communication services at 13.03%, healthcare at 10.58%, and financials at 7.81%. Its top holdings overlap with QQQM, Apple, Microsoft, NVIDIA, and Amazon, but also include firms like Eli Lilly with 2.6% and Alphabet Class C. The top 10 stocks here make up 54.31% of the fund, which is still concentrated, but not entirely tech-dominated. Why does this matter? Because diversification impacts how an ETF behaves in different markets. QQQM is like putting more eggs in fewer baskets, which can soar during tech rallies, but take bigger hits during downturns. SCHG, with its broader reach, may not spike as hard, but it can also cushion the blow when tech stumbles. So what's the takeaway? If you're looking to go all in on innovation and you're not afraid of volatility, QQQM gives you exactly that. But if you want a portfolio that's still growth-focused, just with a bit more balance across industries, SCHG might give you more peace of mind through different market cycles. Both chase growth, they just take different roads to get there. In the end, I'll show you the potential returns from a $100,000 investment over 10, 20, and 30 years with both ETFs. Both perform well, but one will grow to just over $1 million, while the other will triple that, closing in on a $4 million valuation. All right, so we know what these ETFs hold, but how do they actually perform? Let's take a look at how QQQM and SCHG have delivered for investors over the years. Starting with QQQM. Since its inception, it's delivered a total return of 43.97%. That might sound decent until you compare it to the S&P 500, which returned 90% over the same stretch. Why the underperformance? Well, it comes down to concentration. When tech struggles, so does QQQM, and lately, big tech has had a rocky ride. Now let's talk about SCHG. This fund has been on a very different trajectory. Over the same 10-year period, SCHG returned a massive 230.15%, far outpacing the S&P 500 and absolutely dominating QQQM. In the last 5 years, it delivered 120.79%. So what's driving this outperformance? Well, it's that mix of steady tech exposure plus strong showings from sectors like healthcare and financials. The kind of balance that gives SCHG staying power through all kinds of market cycles. Performance alone doesn't tell the whole story, but it does say a lot. Over the long haul, SCHG hasn't just kept up, it's blown past both QQQM and the broader market. And that kind of track record doesn't happen by accident. If you're chasing strong, consistent growth over a decade or more, the scoreboard so far leans hard in SCHG's favor. Now let's talk about dividends. Not just how much you get, but how they grow and what role they play in your overall return. At first glance, QQQM takes the lead here. It offers a dividend yield of 0.72%, which isn't huge, but it's still higher than what you'd get from SCHG. But what's even more impressive is its dividend growth. QQQM has an annual dividend growth of 8.79% with an annual share price appreciation of 7.56%. As for SCHG, it has a lower yield at 0.5% and its annual dividend growth sits at 4.9% annually. Not bad, but clearly more modest. However, SCHG offers an annual share price appreciation of 12.83%, which is much stronger than QQQM. So now that you've got a solid understanding of the strategies and performance of both QQQM and SCHG, let's look into what a $100,000 investment in each ETF could potentially grow into. This comparison will give you a clearer picture of how these two ETFs could impact your financial future, taking into account both capital appreciation and dividend income. Starting with QQQM. Yes, the moment we've been building toward. What really happens if you invest $100,000 into either SCHG or QQQM and let it grow untouched for 30 years. These aren't wild guesses or overly optimistic hypotheticals, they're grounded projections based on each ETF's historical performance and current dividend behavior. And while we can't predict the future, this will give us a crystal clear view of how different their outcomes can be over time. Starting with QQQM, if you put $100,000 into QQQM and let it grow after 1 year, your investment would be worth $108,280. By year 10, it would have grown to $222,400. Give it 20 years and your portfolio would be sitting at $499,154. And after 30 years, you'd land at a total value of $1,131,914. QQQM isn't known as a dividend machine, but thanks to the higher growth rate of those payouts, it ends up delivering far more income over time. By year 30, you'd be earning $10,699 in annual dividends. Out of that $1.03 million portfolio value, a modest portion comes from reinvested dividends, which is $112,364, while the rest, $919,550, comes from capital appreciation. The big question is, can SCHG beat that? Let's find out. Plugging that same $100,000 into SCHG leads to a very different arc. After 1 year, the investment will be valued at $113,330. By year 10, that balance would grow to $345,040. Fast forward to year 20 and things really start to compound. The portfolio would be worth $1,169,727, and after 3 full decades, that one-time $100,000 investment could become a portfolio worth $3,934,993. So what about income? Of that $3.83 million portfolio value, around $3.8 million comes from capital appreciation, while roughly $28,584 was added through dividend reinvestment. So, when comparing these long-term projections, SCHG stands out as the clear winner in total return. After 30 years, a $100,000 investment in SCHG grows into $3,934,993, while QQQM ends up at $1,131,914. That's nearly 3.5 times more growth from SCHG, which is not a small gap. It's a fundamental difference in how these ETFs build wealth. QQQM leans heavily into tech and delivers solid performance during strong bull runs, but SCHG's broader exposure gives it the edge over time. It compounds more consistently across different sectors, smoothing out the ride and boosting total return. If your focus is on long-term capital appreciation and maximizing your portfolio's future value, SCHG is the stronger pick. Want to know which is better between QQQ and QQQM? Click the video on the screen to find out.